Well, good morning. It's me, Kenny Bulgari, your host of the party, and today is Monday, July 17, 2023. And what is it that we need to know? Well, there is a lot going on. We're now in the middle of earnings season for the next 3 or 4 weeks. And stocks this morning are taking a breather. They took a breather on Friday, and they're slightly lower this morning. And on Friday, the big banks did not disappoint, and we're going to get more big boys this week, and then we're going to get the small and mid-sized boys later on this week and into next week. We're going to get lots of economic data this week, and oil backs off because of what? Oh, right, a slowing China GDP. I mean, oh my God. And what are we having for dinner tonight? We're going to have the rigatoni with sweet sausage and tomato cream. Oh my God, that is a really good dish. Okay. So stocks ended Friday mixed, right? The Dow was up 114 points while the S&P lost 5, the NASDAQ lost 25 points, the Russell lost 20 points while the transports gave back 88 points. So all slightly weaker, but not a disaster. And the big banks and some of the asset managers that we heard from did not disappoint, helping investors to forget that there was any banking crisis or fear of a banking collapse any time in the recent past, right? Earnings from JP Morgan, Citibank, Wells Fargo, and BlackRock presented a picture of a strong, resilient economy. Consumers and businesses not deterred at all by rising rates and apparently spending and borrowing like drunken sailors. In any event, the net interest income, which is NII, was the bright spot. And again, I ask, why are you surprised? Why would you be surprised? Interest rates have gone up. Did you not expect the big boys to take advantage of that? Net interest income, is the difference between what they charge versus what they pay depositors, jumped by 44% to $21.9 billion at JP Morgan. Average loans climbed by 13%, and Jamie told us that the U.S. economy continues to be resilient. Consumer balance sheets remain healthy, and consumers are spending. And there you have it. Now, remember, JP Morgan is best in breed, cream of the crop, period, the end. I love JP Morgan. Now, the 3 banks that we heard from on Friday grew their loan books even as rates rose. So think larger credit card balances, and that helped to boost their 2023 lending profits so far. And that suggests that they don't expect to see a major shift in consumer behavior. Now, just a side note, all of these banks allocated more money to loan loss reserves, just in case the economy runs into trouble, causing consumers and businesses to fail or to weaken. Now, some in the media telling us that these rates rose at lightning speeds. Yeah, I guess they did if you weren't paying any attention at all, which is a bit curious to me because while rates are up 5% since January of 2022, it has been, in my opinion, a slow, steady hike. It's been 18 months. For me, that's far from lightning speed. And it was well broadcasted. For anyone to say they were caught off guard that rates were on the rise, like think Greg Becker, CEO at Silicon Valley Bank, is like saying, wait, I had no idea that my bond portfolio was about to get whacked as rates rose. I mean, it's ridiculous. It's not like you didn't know that. JJ and so many of the other FOMC members told you that month after month after month. When rates were zero and inflation was on its way to 9.4% by the summer of 2022, that they were on a mission to kill inflation, and that meant they were on a mission to raise rates, period, the end. I mean, am I wrong? Is that not what happened? Did JJ or other Fed members play I've got a secret? Were investors not aware that the Fed was on the move? I mean, really? Now, we're due to get more banking results this week, and that also includes not only the big boys, but the mid-size and the smaller banks. And you can expect that investors are going to be paying attention to what their net interest income is, because it's widely believed that the smaller banks are more negatively impacted at the extra expense of having to pay higher deposit rates. And that has led to a rash of lowered second quarter forecasts in the last month, right, ahead of this earnings season. So pay very close attention to see what they have to say and how many beats we're going to get versus misses, which I don't think we're going to get a lot of. On the economics column, we heard from the University of Michigan sentiment on Friday, and that surged to 72.6, up from 64.4, and well ahead of the estimate of 65.5, and that suggests consumers are fine. One-year inflation expectations, though, did rise to 3.4%, up from 3.3 last month, and the 5 to 10-year expectation rose to 3.1%, up from 3%. This morning, we're going to hear from Bank of New York, PNC, Bank America, Charlie Schwab, Morgan Stanley, as well as PLD, an owner and operator of developer of industrial real estate, as well as Lockheed Martin, which is a global security company, right, that researches, designs, develops, and manufactures and integrates advanced technology, products, and services into ammunitions, right, aerospace and defense. Recall that Joey told us last week that we've sent so much ammunition to Ukraine that we don't have any left for ourselves, that the shelves are bare. He announced that to the world. And I suspect that's going to be a huge boost to the aerospace and defense sector in the months and years to come, which is why I like that industry. And I've been saying it for months now, right? The ITA ETF is only up 4% year to date. And that includes names like Raytheon, which is down 4% year to date. Northrop Grumman, down 17% year to date. Boeing, up 11%. General Dynamics, down 1% year to date. Textron, down 4% year to date, right? So it's just food for thought. You do you. Economic data today includes nothing really. The Empire Manufacturing Survey expectation of negative 3.5, which is a 9% reversal from last month's plus 6.6. Later in the week, we're going to get retail sales, industrial production, capacity utilization, manufacturing, production, mortgage apps, housing starts, building permits, existing home sales, and leading economic indicators. And yes, investors are going to continue to handicap the Fed's next move, which by now we know is to hike rates by 25 basis points next week. But there's a new wrinkle in the story because St. Louis Fed President Jimmy Bullard, a huge hawk, unexpectedly resigned on Thursday last week to become what? Dean of the Mitchell School of Business at Purdue University. So we could see a more dovish Fed past this July meeting. So is the September rate hike off the table? I guess we're going to have to wait and see about that. Now, U.S. futures this morning are a bit lower, not dramatically, but they're lower, which means they're not up, right? Dow futures down 78, S&P's down 6, and NASDAQ down 3, and the Russell is down 4. I would say that really they are unchanged because those are really, ridiculous small moves. Remember, stocks are coming off not only a winning week, but a winning 6 weeks and honestly a winning year when the S&P broke out of what had been its upper trading range at 4,100 back on June 1st, really surging 400 points since then, or 10% to 4,505 ahead of the second quarter earnings season. And this is as analysts calls for a 7% decline in second quarter earnings while remaining unsure of what the third and fourth quarters are going to be, right? Never mind that what the Fed's been doing and whether or not we're about to enter a recession or the toll that the commercial real estate market is about to exact on the U.S. economy. In the end, investors continue to climb the wall of worry, right? Surmounting the host of negative factors that, kind of worry us on a day-to-day basis. Key earnings this week include, besides the banks, Netflix, Tesla, United Airlines, Las Vegas Sands, American, IBM, Johnson & Johnson, Travelers, CSX, American Express, and Schlumberger. Industries that span the economy and will begin to give us a broader idea of what to expect in the weeks to come. European markets are also lower, and they're lower by a bigger percentage. France down 1.25%, Euro stocks down 1.1%, Germany down 0.5%, UK and Italy down 0.3%, and Spain is the best performer, only down 0.2%. The weakness in Europe being blamed on what? Right, the latest China GDP news, which came in at, it only grew by 6.3%, well below the expectation of 7.3%, to which I would say, do we even believe the numbers out of China? I, for one, do not, which is why I don't invest directly in China. You can't trust them. They can change the rules at any time, and they don't play by the rules at all. There are too many other places, in my mind, to invest your money across Europe and the Asia-Pacific region without being exposed directly to China. And listen, you're exposed to China if you're in, names like Apple. Earnings season is now in high gear across the Eurozone. In addition, investors across Europe are handicapping what the next ECB move is going to be in the other central banks across Europe, right? All indications are for higher rates, which should surprise nobody. The 10-year Treasury in the U.S. is yielding 3.78%. The 2 years yielding 4.72%. Shorter duration 3 and 6 month bills are yielding 5.4 and 5.49%. So not a dramatic move in yields in either direction. Oil is taking a breather this morning. It's down $1.10 at $74.31 a barrel after the 15% spike higher over the last 2 weeks. The focus today? The Chinese GDP news suggesting that the second largest economy in the world is slowing, and that means what? Oh, right, demand destruction. Come on, stop already. The Saudis are holding current production cuts through December 2024, and if they sense that demand is declining at all, what are they going to do? They're just going to cut more. It isn't rocket science, right? Oil, which had traded up and through all three trend lines over the last couple of weeks, has now breached the long-term trend line at 75.57 and is testing intermediate support at 73.50. I wouldn't panic, because tomorrow we're going to get a different story out of China, and everything's going to be great. Oh, they're buying all kinds of oil, demand is strong, and all that baloney. Anyway, the dollar index remains sub 100 at 99.89. And if Jimmy Bullard, if his resignation means anything, and if we see a more dovish Fed, then expect the dollar index to continue to move lower, and a weaker dollar is going to benefit the commodity complex, right? The S&P ended the day on Friday at 45.05, down 5 points. It's about, it continues to be about the good macro data points. It's about future Fed policy. It's about earnings season. And yes, it's about the momentum. And until we get a really negative catalyst that derails the market, like I told you last week, then expect any pullback is going to be met with plenty of buyers, right? The push up and through 44.80 did exactly what the Momo guys wanted, right? The momentum guys. It ignited the algos because it was a technical buy signal, and that helped us send stocks higher, and I think that will continue, because as we back off, they'll find there's plenty of buyers and stocks will move higher. While I love the action, I think it is a bit disconnected from reality. But like I said, I suspect that any pullback will be met with plenty of buying interest, which is why I keep saying, have a plan and stick to it. Don't chase the names that are already stretched. Put new money into those sectors that have underperformed and may be boring but have strong fundamentals, i.e., like the aerospace and defense industry that I've been talking about for a while, and that clearly represents some value, as most of them are negative on the year. Not huge, but they are slightly negative, and they've actually started to see some investor interest. So we're having for dinner tonight. We're having the rigatoni with sweet sausage and tomato cream. This is a classic recipe. I love this. For this, you need the big rigatoni pasta, you need garlic, onion, sweet sausage, white wine, heavy cream, and crushed tomatoes. Heat a pot of salted water on low, right? Get the pot of salted water ready. Just put it on low on the back burner so that it's ready when you need it in about 40 minutes. So keep it on low, it'll start to heat up, and when you turn it to high, it'll boil quickly. Now, in a large pot or a saute pan, you want to heat up some olive oil, add the crushed garlic and diced onion, Vidalia if you can get it. Saute it till it's nice and soft and sweet. Now you're going to add the sausage meat, which you have removed from the casing, so crumple it all up and cook it in there and brown it, right? After it's all brown, you're going to add 2 cups of Pinot Grigio Santa Margherita and let the alcohol burn off. Open up a 28-ounce can of plum tomatoes and rough crush them with your hands so that they're a bit lumpy. Now you can use your hand, you can quickly pulse them in the food processor. Add this to the pot, bring it to a boil, and then immediately turn it to simmer and let it cook for about 30 minutes, stirring it constantly, but don't go too far because you have to stir it again and again and again. So make sure you're around the kitchen. After 30 minutes, turn off the heat, let it cool for about 5 minutes. Now add 1 cup, maybe a little bit more of the heavy cream, which you've allowed to come to room temperature. Now you can use light cream, but heavy cream gives it obviously a richer taste. Stir it well. Now turn the water up to high and add the rigatoni to the boiling water. Cook it until it's al dente, 8 to 10 minutes, straining, reserving a mug full of the pasta water as always. Now add this pasta directly to the saute pan that's got the sauce in it. Stir it, mixing it really well, coating it, right? Add a handful of 2 of fresh grated Parmigiana cheese and mix it again. If it looks like it's sucking up all the sauce, that's fine. Take a little bit of the pasta water and add it in just to moisten it up. Don't make it soupy. Just add it in so that it's nice and moist, right? Then you want to serve this immediately, offering more fresh grated Parmigiano on the table for your guests and for yourself. And then you can finish up the bottle of Pinot Grigio Santa Margherita, which is a white wine with this dish, even though it is a sausage dish. But if you really want, then I would choose a lighter red. If you want to drink red wine with this meal, I would choose a lighter red, something like a Pinot Noir or Chianti Classico, which is always a fan favorite. In any event, look, the week has just started. I'm still up here in Cape Cod. I'm going to be here for another couple of weeks, and then I'll be back in Florida. But until tomorrow, take good care.